So our first topic is going to be time value of money. And I wanted to go over, this is our material for the week that I want you all to go through and read and go through the reading and the interactive illustration. So the way to use this material is to go through each chapter and such chapter and go through all the terms, and then go through the interactive illustrations and learn interactively. So I just wanted to go over what is this reading all about, partly why we're studying this. We're going to, in this class, learn about how to understand what is driving value in a firm, what is driving what people call risk. What is really risk? A lot of people say risk is a risk of a declining growth, or it could be a risk of a declining revenue. It could be a risk of a declining market share. From a risk management perspective, it could be cybersecurity risk. It could be currency risk. It could be human capital risk, economy risk, sovereign risk. So we're gonna look at how do you mitigate these risks, and how do you use also strategy and processes to generate value, to make value essentially more certain. So we're going to continue to understanding what is risk. And this first chapter really talks about the idea of what is time value of money, a very correlated to the idea of risk, actually, because what is time value of money? It basically says that if I was to get $100 in the future, I have to discount it by a certain discount rate. What is that discount rate? Usually, what would I invest that $100 into, and at what rate? So if the savings rate is 2%, which is about at that right now, and we're just talking about straight investing, that discount rate would be 2%. So that's an important piece to understand, is the present value and the future value in this first module. And actually, I would encourage you to kind of go through this concept. And the idea is that what is the value of basically the present value of $100 in, for example, going into 3 years from now. So $100 in 3 years from now at the risk rate of 7 is actually worth $81. Why? Because if you invested $100 today at 7% every year, you would actually get to $100. So the higher the risk rate, it's you're going to have a lower present value of something that you're going to get in the future. So as you see, this is kind of today, and this is the past, this is the future. So $100 in 3 years at this rate is worth actually 133. So if you're gonna get something, if you're gonna get $100 in 3 years, you're essentially over here, and that today is worth $75. So that's what we use when we estimate earnings, and we look at companies' earnings. We have to discount them and understand what are they worth today. The value of anything is its present value of future cash flows. So we look at the cash flows, which we're going to look at sales, its revenues, its incomes, and their discounted value, which is this. And what we're going to focus in this course on is understanding what is the risk, what is this discount rate, why is sometimes it's 2%, very safe, right? You have higher values, as opposed to 9%, 8%, could be 20%. Now the values come down, there's more risk.